Here is something almost no one is talking about. On January 1st, 2026, a brand new tax rule kicks in. If you are 50 or older and you made over $150,000 at your job last year, the government just took away one of your biggest tax breaks, the catch-up contribution, the thing that lets you put an extra $8,000 into your 401k. You can still make it. You just have to pay tax on it now, and the bill comes to $2,560 per year out of your pocket. Let me show you what this looks like with two real people. Sarah and Mark both turned 55 this year. Both make $200,000 at the same software company. Both want to do the same thing, stuff an extra $8,000 into their 401k. The catch-up. The whole point of the catch-up is to help people who started saving late close the gap before retirement. It used to be a no-brainer. Tax money in, pay tax later when you retire. Sarah did it in 2025. Mark plans to do it in 2026. Same job, same money, same age, different rule. Sarah, in 2025, puts in $7,500 pre-tax. Her taxable income drops by that much. She saves about $2,400 on her tax bill. That money never gets touched by the IRS until she pulls it out in retirement. Mark, doing the exact same thing in 2026, has no choice. His catch-up has to go into a Roth bucket. He puts in $8,000 and gets zero deduction. He owes the IRS $2,560 more than Sarah did for doing the same thing. 1 year later, I know what you were thinking. Wait, but I just want to save more for retirement. Why is the government punishing me? You are not crazy. The catch-up rule was created in 2001 for one reason: to let people who fell behind on saving make up for lost time without taking a tax hit at peak earning years. The whole design was, save now while you make a lot. Pay tax later when you make less. Congress just flipped that on its head. They are saying, you make too much. You can still save, you just have to pay us first. Here is the math that nobody is showing you. You are 55. You make $200,000 a year. That puts you in the 32% federal bracket. $8,000 times 32% equals $2,560. Gone. That is your lost deduction every single year. And it gets worse if you live in California or New York. At another 8 to 10% state tax, you are looking at $3,000 a year. To do something, the IRS used to give you a tax break for doing. Now run that for 10 years. Age 50 to 60, $2,560 per year. Every year, just in lost federal deduction. That is $25,600 you are paying the IRS now, instead of later. And here is the cruel part. When you actually retire, your income drops. Most high earners end up in the 12% or 22% bracket in retirement. So the deduction you lost, you were paying 32% on it. The withdrawal you would have taken, you would have paid 12%. The math is brutal. You are paying triple the tax rate on the same money, just because of when. So why did Congress do this? Here is the part nobody tells you. It is not about retirement security. It is about cash flow. When the government lets you defer tax, they wait 20 years to get paid. When they force you into Roth, they get paid right now. Secure 2.0 was scored to raise about $23 billion in revenue over 10 years. That number is real. It is in the Joint Committee on Taxation report. The catch-up rule is a quiet tax hike on the people most likely to actually use catch-up. Late savers in their 50s. Pay me now, says the IRS. Not later. Okay, so what do you actually do about it? Step 1. Pull out your 2025 W-2. Look at box 3. That is your FICA wages from the employer running your 401k, not your household income, not your spouse's income. Just that one number from that one employer. If it is over $150,000, the rule hits you in 2026. Step 2. Call your HR or 401k provider. Ask if your plan offers a Roth option. If they say no, you are not doing catch-up at all in 2026. None. The whole option goes away. Step 3. Look at the mega backdoor Roth. If your plan allows after-tax contributions and in-plan conversions, you can move way more money into Roth than just the catch-up. Step 4. Max out your HSA first. 3 pre-tax buckets. No FICA. No income limit. Step 5. If you have access to deferred comp at a big company, that is still a pre-tax option for high earners. Use it. Step 6. If you turn 60 between 2026 and 2029, the super catch-up jumps to $11,250. Same Roth rule, but way more. Here is the bottom line. The catch-up was designed in 2001 to help retirees catch up. The 2026 version helps the IRS get paid faster. If you are over 50 and over $150,000 in W-2 wages, you just lost a deduction worth $2,560 a year. $25,600 over a decade. The rule is buried in IRC Section 414, V7, and almost nobody at your job knows about it yet. If you have a coworker over 50, send them this video. They have 8 months to plan. Subscribe so I can show you the next one nobody is telling you about.